Ladies and gentlemen of the crypto space, we're live on a Monday, February 6th at 10:49 a.m. This is a very complicated topic that many people hear spoken on social media by many people, not just me, the likes of obviously Jeff and Emil and Eurodollar University, and many others. It's an unspoken component of the system, and we're going to explain in many regards, especially Eurodollars today, particularly because extraordinary conditions are present that are very obvious when you look at the bond charts, are very obvious when we consider the primary Fed talking point, are very obvious with regard to what we're seeing with emerging market capital flow, and all of that coming together in this picture that I'm starting to see, and it all reduces to systemic liquidity. I've been talking about that for the last weeks. Everything is about liquidity. What is liquidity? Liquidity is currency. You need currency to buy shit. The more currency you have, the more shit you can buy. Now, for the last decade, um, the Fed and U.S. government has been artificially affecting endogenous systemic liquidity, endogenous, inside of the United States. Now, the fun thing to start to consider is exogenous liquidity, dollars outside of the United States. And it gets complicated because it's not just dollars, there's other currency units. But if we reduce everything for simplicity to dollars in the U.S. and dollars out of the U.S., we can have a relatively simplified conversation about pressure, upward pressure, or downward pressure if there's lack of liquidity. So what does pressure do? If there's a pressure imbalance, pressure flows from high pressure to low pressure. So if you have more systemic liquidity inside of the U.S., it versus outside of the U.S., you get different flows back and forth. So what is the endogenous liquidity, artificial liquidity? That is the Fed balance sheet minus the reverse repo minus the Treasury general account. So artificial liquidity was the exogenous outside of the United States artificial liquidity. So the Eurodollar system, which was pretty much started in the 50s. And if we look at the bond chart, we'll pull that up. Let's pull that up right now because it's really all about bonds to understand global systemic liquidity. All right. I got a couple of charts up that are pretty interesting. Let me pop it over to the main screen. So I'm not too savvy about, you know, early um, early 1900s to the 50s, but the 50s magic started to happen. And why would yields go up? Obviously, there's the process of in, endogenous within the United States handling monetary policy to affect liquidity conditions to account for the amount of circulating currency units, that's liquidity, and that plays into consumer price inflationary pressures. So the Fed is always in a conversation. This is exactly what they talk about. It's just that this isn't their talking points. They're always in a battle with managing internal affairs, and when they do that, there's implications on the broader system around the world. So when you have increasing rates, you have decreasing price point of a bond. Face value is face value if held to maturity. So if you have a $100 long end bond, 10-year plus, it's going to provide $100 upon maturation. So if you hold it for 10 years, here's $100. What if it's trading at 90 bucks? 95 or whatever the hell the circulating price point is. It's trading less than $100. So you hold it. It's worth $100. They'll give you $100 when it matures. So outside of the United States, you could buy $100 for $95. Now, the whole trick there was the Eurodollar system. a banking system or a series of counterparties that would say, all right, give us the bond. Here's $100 of dollar liabilities, which is basically the way the global financial system works currently. All it is a balance sheet, a ledger of credits and debts. Someone owes someone dollars. Ultimately, everything reduces to M0, which is base money. So everything is a derivative. The whole system is a series of derivatives. So this international banking system started accepting dollar-denominated collateral, dollar-denominated bonds in this example, and issuing dollar liabilities, which is the exact same thing when you go to www.chase.com and you see your balance. That is a dollar liability. That number on your screen is a dollar liability. And that's what you see on a computer screen in England when you give a bank $100 face value of U.S. bonds that cost you $95 to buy. Now, maybe there's interest rates, a few basis points to borrow that, but basically, if you ignore mark to market, the U.S. will pay $100 on that bond upon maturation. And that is the way the system works. What is mark to market? So people could understand. So the price point of the bond changes, but if you're over time, so it goes down to $90, $80, whatever the hell it goes down to. It fluctuates. It's volatile. But when you're taking an account based on the premise of holding it to maturation, mark to market's irrelevant. Upon maturation, this is what you're going to get. So therefore, the bank could credit you the face value worth of liabilities. So, what does this chart say? We just had 40 years of tighter international liquidity conditions. Cycle after cycle, Eurodollars were more expensive, higher price points, which put pressure on FX markets because there's your balance there, which is cheaper. Everything in the world is denominated in dollars. The vast majority of things, at least the significant things, and that's obviously changing, and this chart shows that it's changing. So if you want to buy something, you got to buy dollars. So where are you going to buy them? You go to the Exxon on 35th Street or the Exxon on 40th Street. One has gas for $1, one has gas for 95 cents. You're going to go to the gas station that's giving you 95 cents. So you're either going to go to the Forex market for the cheaper dollar, or you're going to buy bonds for the cheaper dollar, because there's banks around the world that will give you face value worth of liabilities for the bond that you just purchased for a 5% discount as compared to the FX market rate. Right now, since 2020, and this is an inflection point. That's a criticality. It breached. And to top it all off, how do you confirm that breach? What's the primary Fed narrative? What is the primary Fed narrative? Higher for longer. It all makes sense. The Fed is not stupid. They know what they're doing. Why is the Fed narrative higher for longer? They need to juice the world with dollars. Why? Because everyone hates the dollar and they want to get off the dollar because the dollar's been scarce. Russia, China, Saudi Arabia, they want to start denominating shit in other than dollars. How do you combat that if you're the United States? Give everyone what you want. You bribe them. You juice the system with dollars. Now, you can't print the dollars and just give it to people. You get it into the system using the structure of the system that has emerged over the last 100 years. And beneficially, how do they do that? Treasury prints paper, prints bonds, long-end bonds, because short-end bonds are domestic U.S. commercial banking to balance their books, their balance sheet. Great. So that raises debt. That raises capital for the United States to finance fiscal spending. And it also exports dollars outside of the United States, juicing exogenous systemic liquidity. Higher for longer. The Fed knows they need to get these rates up. They need to keep them up, which means they need to suppress volatility, which means they need to put upward pressure on yields and put the prices down so everyone around the world has a capacity to buy discount Eurodollars. Discounted dollars that create a dollar liability equal to face value of the instrument. This is an extraordinary chart when talked about in these terms. Higher for longer absolutely makes sense. They are draining domestic liquidity. Frankly, okay, so maybe they're not intentionally draining domestic liquidity. There's an argument that they got to run down the balance sheet such that they have room, they have firepower, they have other complexities they're dealing with, like their negative balance they're accumulating with the treasuries. That's complexity. It's something they could kick the can down the road. That's fine. But what happens with QT? Frankly, maybe it's firepower for what they want to do, considering higher for longer narrative. If they could sell trillions of dollars worth of bonds, they could push the price down, which contributes to higher for longer, which contributes to a discount on dollars outside of the United States being put through the Eurodollar system. They are bribing the rest of the world, giving them the coveted dollar such that the system entrenches. The global dollar system was partially an opt-in system, partially a coordinated strategic system when they made the deal with the Saudis to price commodities, oil, energy in dollars, but it was also opt-in. So the system is what it is because everyone said, all right, I'm going to borrow debt in dollars. Great. So that's how we got to where we are with the dollar. So now we're going to flood the system with dollars. It's going to further entrench or at least support the continuity, the continuation of dollars being the source of global systemic liquidity because there's going to be more of them. Fascinating. So what is this? This is a damn inflection point. This inflection point is consistent with a complete change in narrative of domestic liquidity versus international liquidity. There is every time, if you remember, every time that we got to this trend, the Fed flip-flopped on rates. Why? And why didn't they flip-flop this time? Because now, because of geopolitical considerations, there is more of a need for international dollar liquidity as compared to domestic liquidity. That's perfectly consistent with inflation. All right, great. Coincidentally, the world is having a geopolitical crisis where flooding the world with dollars is going to benefit the United States, further entrenching dollar hegemony. And in the United States, we have excess liquidity, which is contributing to consumer price inflation, so we could take the foot off the gas of domestic artificial liquidity by trimming the balance sheet, which decreases the price of dollars internationally. The Fed is not stupid. They're literally doing exactly what they need to do. They just need to keep doing what they're doing. They need to stick. This is exactly the play that they should be doing when you look at it from this perspective. Drive down domestic liquidity, contribute to decreasing consumer price inflation, drive down bond prices, which increases international liquidity, making it cheaper to access dollars, further entrench the dollar in the international system. It all makes sense, all too much sense. I'll keep going with this. I wouldn't mind running through my tweets because folks often see my tweets and they're like, what the fuck is this guy talking about? So let me go through the comments, and if I could interweave gracefully, which is rare, I'll go to the tweets also. Hello. He meant hello, but hello. Good morning. Dan's in the house. Yes, we're live. Good morning. Present. Hey, Noah, last stream you mentioned the warden. How do you calculate APR and the payouts in USDC? I don't know. I think there's a lot that's unknown about the way the system has been implemented, but I would like to learn more. So I think Discord is probably the place to ask them about the implementation they have. Yoram, Happy Monday, a pleasure. Yeah, this is a big one. Hallution. This is big because this is telling us that we're not headed. They need to suppress volatility. Otherwise, otherwise you get currency volatility. When you get the causal relationship between all markets is bond market volatility leads to currency volatility, leads to risk asset volatility. And frankly, I think an unspoken mandate is stability, which means market stability, which means price stability. Why stability? Because stability contributes to civility. People get pissed when shit is unstable. So the Fed has a lot of firepower to maintain stability because the primary driver of systemic stability is decreasing bond market volatility. Yellen said it herself. It's very fascinating when you start to piece together what they say and you're like, oh shit. So she's worried about bond market liquidity, which is basically bond market volatility. And when you get buy side or sell side imbalance, you get volatility. If you suppress bond market volatility, you're going to suppress currency market volatility, which means you're going to suppress risk market volatility. And what has the VIX been doing? And now we've had obviously a fair amount of currency market volatility, especially with what happened in England. But if you look at the euro volatility index, I was looking for more volatility indexes. I would love one for MBS. I don't even know if I could get some of this shit. They don't even have a volatility indicator for yen. That's really what I want. I would love a volatility indicator for the DXY. But look where the volatility is. Why is the volatility here? Why is it red? This is wonderful. Look where the peak was. October of 22. Look at the peak. Look where the peak in currency market volatility was. And what a risk do. Now we look at one of the most important indicators I've been looking at recently, bond market volatility. Where was the peak in bond market volatility? October of 22. Bond market volatility leads to currency market volatility, leads to risk market volatility. You strip out the bond market volatility, the currency market stabilizes because the rest of the world can finally print their damn Eurodollar. Top it all off, we're making it extremely favorable conditions to print Eurodollars. We're giving them a discount. Global fire sale on dollars. No difference between a dollar liability and an actual dollar. There's far more magnitude more dollar liabilities than actual dollars, to the point where the vast majority of currency units are literally just synthetic dollars, dollar debts. Loki, hey Noah, very happy to get your thoughts on DXY liquidity stuff. You're very welcome. This is historically complicated stuff, but this stream, if there's any stream you watch a couple times, it's this stream because this stream says the entire system is relatively stable for intentional reasons. Yes, you can have systemic events, but you know who has a shitload of firepower to quell bond market volatility? The Fed. Why? They got trillions in the balance sheet, and to top it all off, they got the reverse repo, which could squash short end volatility. Whether they, well, not, short end volatility would entail they have fine grained control over the RRP so they could balance what's going to the RRP which versus what they force banks to buy in the market for the short end. Now, my bet is they call a policy meeting with the bank CEOs and say, oh, we're going to cut the rates on the RRP. We're going to give you rates. You can't just dump the RRP. You can't just squash the short end to zero. Then all of a sudden you have an uninverted yield curve. Whoa, all of a sudden this inverted yield curve that everyone's talking about would be uninverted and normal, where the short end is lower than the long end. You're getting actually paid a premium on your long duration debt. The RRP and the Fed balance sheet gives them immense capacity, immense firepower to stabilize the system. They have built an armory of tools, so to speak. Do you see any bubbles currently in the market? Well, technically it's all a bubble. everything is a bubble. Why? Because it reduces the currency because everything's a bubble on top of M0. And the fact that everything is leveraged on top of M0 means that volatility introduces deflationary risk to anything on top of M0. That's the bottom line. So it's all a bubble. I see bubbles differently than everyone. I see currency different. I see liquidity different. I see markets very different than most people. So it's all a bubble. So it all comes down to their capacity to manage the inflation state, the inflated state of the bubble. And what has the Fed done over the last 2 years? They built the war cannons. $2 trillion war cannon, and to top it off, whatever the hell the Fed balance sheet is at, a multi-trillion dollar war cannon to suppress the price point on bonds, which is obviously historic trend deviation. And why do they want to suppress the price point on bonds? So the rest of the world now has access to dollars, and they can further entrench the dollar system worldwide in a time period where the rest of the world, at least the eastern part of the world, is actively engaging in and trying to separate from the dollar system. Fascinating stuff. Maximus, agree the Fed isn't stupid. Usually people don't consider geopolitical plays when looking at Fed actions. Yeah, I think that is well said. Based on what I'm seeing and based on finally understanding why the Fed is saying what they're saying and why Yellen has said a couple of things she said, if they further increase yields, and sure, that increases complexity, with what Luke talks about in sovereign debt, capacity to service sovereign debt, and it's complicated because the GDP. But frankly, they have some serious tools to finagle this stuff. And right now, the most important thing is low volatility of the bond market, juicing exogenous dollar liquidity around the world, which is what they're doing. It's working. And reducing consumer price inflation domestically, draining endogenous liquidity in the United States, which contributes to reducing consumer price inflation. The labor market looks great, but now, some folks have argued that the labor market is fudged, and I have definitely argued that there's 100 million people in the United States that don't work, so we don't have a crisis of overemployment, we have a crisis of underemployment. We have complexities with regard to salaries, and all of that contributes to social stability and civility. So we definitely have other complexities to address, which is probably more so a congressional consideration rather than a monetary policy at the Fed level. But overall, I think they have a good grip of systemic financial stability. And I now finally understand their play, why this chart was allowed to breach this trend line so ferociously to the point where it's a trend violation. And we have retests. And this should continue to directionally change, considering the geopolitical pressure. They need to allow the rest of the world to have access to dollars. Otherwise, you have, where do you think Sri Lanka is going to go? The freaking just collapsed. It was a currency shit show. So make the dollars available. You want people to use the currency, you got to make it available. And this is going to make it available. Rob K., what do you think about the China pumping liquidity into the markets narrative? Could that offset QT? No, that's increasing liquidity. Well, yes, it's offsetting QT. But QT isn't doing what you think it's doing. You got to remember, now, I don't care much for U.S. markets. I don't care much for the stock market and NASDAQ. They're inflated pigs because everyone in this goddamn country has no idea what they're doing with regard to capital management. So they don't invest in stocks, which are stocks, the U.S. stocks, because it's the U.S. stock market and we're in the U.S. It's an inflated pig. Crypto markets never received a significant amount of capital flow that traditionally went to the stock market. It's because of those stupid 401ks and passive investors. The stock market goes up over time. Of course the stock market goes up over time, but bear in mind, This is a very different systemic regime. This is a regime change you're looking at on the chart right here. And there's a reason why this was allowed to occur. It was needed. There is a great reason to think that U.S. equities can just stagnate. I think Drunken Miller was spot on when he said a decade of stagnation in U.S. indices. You know, you'll still have your mandatory flows, your 401ks, you know, just the dumb cash just piling in. But you don't get your spikes, you don't get your bull markets. That's marginal. In aggregate, the aggregate flows are what drive markets up and down. The marginal flows just, you know, give you little peaks and troughs, and they don't drive it with real directionality. So this chart right here tells me the aggregate flow of capital is going to be outside of the United States. This is the biggest directionality shift in 40 years, and you're going to have an emerging market, bull market, that's going to outperform the domestic United States markets until this trend reverses. But what do we talk about? This trend just started. Trends don't just spontaneously reverse. They continue. They are self-sustaining. They substantiate themselves. They reinforce themselves with momentum. This is fascinating to see. This is also even more fascinating to understand the causality of why this occurs. Hope that helps, Rob. Maximus, the Volcker shock was a geopolitical move as well. It's all geopolitical. Has to be. So if you take the geopolitics and apply it to every narrative we hear them talking about, and this data, the way I've broken it down to you guys, you're like, oh, all right, this makes sense. Watch this video once or twice. This is probably the most reduced perspective that I can offer as of right now on why everything's occurring the way it's occurring, and it makes ridiculous sense. One curious view of pleasure. Interesting news out of Visa. Looks like they'll integrate USDC as a settlement layer. Oh, great. Well, we know that. We're not surprised. We've been doing this shit for years at this point. Isn't that lovely? Look at the capital markets in the crypto markets. It's a capital market. It's an emerging market. And what's the most important thing? This entire conversation, we're talking about the likelihood of systemic liquidity favoring the rest of the world versus the United States. And this trend deviation here being really a directionality shift supported by peak globalization. If globalization is on the decline and trade, Luke's, deficit, talks about twin deficit where we're required to export dollars, and that's why we have the trade deficit. How do you counteract peak globalization? Make cheap debt. Drive the price of debt down so the rest of the world can use the Eurodollar system to buy cheap dollars. That's how you get dollars to the rest of the world. That's how you potentially head down the road of what Jeff and Emil talk about, disinflation of global currency. You got to flood the system with dollars. And this is the starting indication of that being at least rational narrative that's playing out, getting into the heads of the narrative makers, folks at the Fed, IMF, WEF, so on and so forth. Flood the system with dollars. I think this makes a great deal of sense. Thank you all. Good comments. If you have any tweets you want me to explain, I could go through them, a couple of them. I don't want to bore you too much. This will be redundant with what we talked about so far in the stream. Yeah, let's go through a couple. If the Fed wants to bypass global trade to export dollars, there's a way to do it. There's a way for Treasury to do it. Print cheap Treasury notes. The Treasury notes are auctioned at market rate. They're not necessarily auctioned at face value. So if someone's buying a $100 10-year bond for $95, or whatever the hell the market rate is, they could go to a bank and get $100 worth of liabilities, which is $100 on their Chase.com screen for what they just bought for $95. They just got a 5% discount on dollars. The bull market is going to be a melter. Falling behind on paper issuance with rates already at these levels, exogenous dollars are going to flood the system. They're going to have to flood the system with debt. Why? The debt ceiling. It's perfectly consistent with what's going on right now domestically. We got a debt ceiling issue. What happens when they finally raise the debt ceiling? They're going to have to print bonds and sell them. What is the rest of the world going to do? They're going to buy the bonds because they're not buying bonds. They're buying 5% off on dollars, a fire sale on dollars, getting cheap dollars because the vast majority of world trade is still dollars. And they're going to buy a discount on dollars? They're going to buy it hand over fist, especially if the Fed can get rates a little bit higher, just a little bit higher, and just keep it higher for longer. Isn't that their narrative? Higher for longer? You know, how how long is the sale on dollars going to last? You know, we're going to keep it higher for longer. Isn't that interesting? Damn, the bull market is going to be a melter. So yeah, so the bull market isn't in the United States. You know, likely not. Irrationally, it would be. So if we flood the rest of the world with dollars, you know, there's obviously a chance that the rest of the world says, all right, I'm going to invest in the United States. But come on, come on. Investment, not malinvestment, says you buy a value stock at a good P&E. You buy something at a discount. Who the fuck's buying 20, 30, 40 P&Es U.S. inflated pig shit? It makes no sense other than the mandated funds, fund managers, 401ks, whatever. So, if you're flooding the rest of the world with dollars, you would expect significant investment in emerging markets, outperformance. Where does capital flow? Capital flows from underperformance to outperformance. That's going to make great investment for people in the U.S. into emerging markets because there's going to be more currency units. Therefore, assets in emerging markets are going to outperform. As we're draining liquidity in the U.S., we're making it cheaper outside of the U.S. Very interesting. Bonds are row dollars. Row means rest of world. Bonds are dollars in the rest of the world because of the banking system and the service that it provides. Face value is a dollar print. Thank you, honey. She gave me a lovely cup of coffee. Conditions exist for a significant bull market. This is foreshadowed by systemic liquidity and the likely need for the U.S. to flood the market with relatively cheap bonds. Endogenous U.S. liquidity is draining. Exogenous liquidity is booming. Won't be U.S. markets. For a price of a stock, something to go up, people need to buy it. For stuff to be bought, there needs to be currency. For stuff to be bought at higher prices, there needs to be an excess of currency. Where there is an excess of currency, prices of things will be higher. This is exactly what we see with CPI. This is exactly what we saw in 2020 with U.S. stock markets. Liquidity tells you how much supportive pressure is in the system. Currently, the structure of liquidity, Fed policies, and global banking indicate conditions exist for a meaningful depreciation of U.S. markets and capital flows to emerging markets. So, I say depreciation of U.S. markets because capital flows from underperforming to outperforming. If you're flooding the international system with currency units, they will likely outperform, which should draw capital out of U.S. markets. Rationally. Clearly, irrationally, people are still going to buy 20, 30, 40 P&E pig shit. So we'll see what happens there. This is where I talked about higher for longer. They said higher for longer, not because they're trying to hurt markets, not because what everyone thinks on crypto Twitter. They said higher for longer because they need higher for longer to drive liquidity outside of the U.S. to entrench, reinvigorate U.S. dollar hegemony. That's the deal. Last couple, and then we'll wrap it up for the day. I think we're at the point where it's opportune for the Fed to support higher interest rates at all costs. How about that one? Everyone's like, when are they going to pivot? No, no. You're trying to invest in the wrong market in a global set of markets. You're trying to invest in the wrong place. They need higher rates to entrench the dollar around the world, and the higher rates has domestic implications. Now, the most important thing, crypto markets are not a U.S. market. Oh, I was trying to say that a little bit earlier. I don't know if I said that as explicitly as I really need to reinforce. And I say the U.S. market goes down, everyone correlates the U.S. markets with crypto markets. The crypto space is not a U.S. market. The vast majority of currency units in the crypto space are Eurodollars. They're Tether. Tether is the classic Eurodollar collateralized debt position. You want to understand if there's booming U.S. endogenous systemic liquidity? You look to USDC, redeemable for $1 liability at a bank, which could be redeemed for $1 physical. That's another story. But when domestic U.S. liquidity is booming, you're going to see USDC outperform Tether and vice versa. When international liquidity is booming, you're going to see Tether have a higher market cap than USDC. And everything in the planet operates in cycles. This will cycle. There'll be flows, there'll be waves, because that's how systems operate. That's how nature operates, that's how biology operates, and that's how financial markets operate, because financial markets are a manifestation of nature, biology, in turn, nature. Hope that helps. Anyway, this was a series of wonderful tweets today that really helped break down the way the system works, and I captured most of it in our talk today. Trevor Van Meters in the house, a pleasure. Hi, Lucy, and one more liquidation, then up only. Don't look for the volatility. Look for the liquidity. That's why I always tell you guys to look at this chart on DeFi Llama. You want to know when everything is going to go up when you start to see liquidity go up. Liquidity goes up, things go up. And then once liquidity starts going up, then you start to have technical analysis conversations about which things are receiving the liquidity, which things are going to outperform versus one another. Within a market, each one of these is a separate market, has a separate liquidity flow, has separate considerations with regard to why liquidity flow to different markets as well as different protocols within each market. But ultimately, the common denominator to all systems, whether you're talking about a crypto market, each one of these is crypto markets, or you're talking about emerging markets, sovereign nations, or indexes, or subsets of a sovereign nation, a more discrete financial market, the common denominator is liquidity. Liquidity up, things go up. Liquidity down, things go down. Liquidity then flows based on balances and pressures in the system. And what are balances and pressures? Incentives. And that's what we talk about with regard to currency producers. Currency producers in the crypto space. You need recycling. Why? Because that's historically what countries have done. What do you think bonds are? Bonds are recycling of currency units. You're able to print currency units. As long as you can recycle them, now you have the loop. You have the balance of the equation. And what you need to do is provide incentives to balance the equation so you have control over what? Systemic liquidity. If you're printing too much and you're not recycling enough, you have an increase in liquidity and you have the appreciative pressure. And that's what Keynesian economics wants, or touts, is the capacity to manipulate the parameters of the system to balance the equation to have controlled systemic liquidity. And what do I argue? The only flaw in Keynesian economics is humans. So the breathtaking revolution of smart contracts is the potential for deterministic monetary policy. You get the humans out of the equation, you get rid of pretty much what I argue is the only problem of the system. Let's wrap it up. One Curious View, it's a pleasure. Maximus, you put a lot of the puzzle pieces together for me today. This was a big one today, guys. This is the culmination of a couple of years of really starting to understand things. We we literally put into perspective in this stream Jeff and Emil, Eurodollar University. We talked about one of the most complicated topics that most people go eyeglossy on trying to understand, and we broke it down in terms of what the Fed is doing, why they're doing it, and how markets are behaving, how they're performing. And we discussed literally providing explanation of why the markets are doing exactly what they're doing, and it's exactly what they're doing. Very, very interesting. Thank you all for joining me. Monday, February 6th, 11:29 a.m. I wish you all a good one. Tell everyone to subscribe because they need to hear me so I can help them do better, and we all can do better. After party on Discord for the most rational community in the entire crypto space. I will see you all in there. Have a good one. See you Friday.